Welcome back to the Wealth Planning Podcast with Brister Law. And if you're a business owner, a high-income W-2 earner, or just an investor who's ever said, I make good money, but taxes are absolutely crushing me, then this episode is for you. Today, we're talking about real estate, and not just in the Instagram guru, get rich quick sense. We're gonna be talking about how the tax code treats real estate differently from almost every other asset class, and how people who understand the rules are legally wiping out 6 figures of taxable income. Specifically, we're going to be covering the short-term rental loophole, material participation, and what actually counts, real estate professional status and why it's misunderstood, partial asset dispositions, and the self-rental strategy most business owners have never heard of. This is one of the most powerful areas of tax planning and one of the most commonly screwed up when it hits the tax return. Let's break down in the right way, and let's talk about why real estate is treated differently by the IRS. The first thing that you need to understand is this: the tax code does not treat all income equally. W-2 income, fully taxable. Business income, taxable unless planned strategically. Investment income, it depends on the category. Real estate, however, sits in a unique position. Congress has intentionally created incentives around real estate because it creates housing, creates jobs, and drives local economies. And as a result, real estate owners get access to use depreciation, accelerated depreciation or bonus depreciation, losses that sometimes can offset active income. But here's a catch: most rental real estate losses are considered passive, and passive losses generally cannot offset active income like W-2 wages or business profits. And that's where the strategies we're about to talk about come in. Let's start with one that everyone is talking about, and it's the short-term rental loophole. Here's the basic framework. A short-term rental is treated differently than a traditional long-term rental if the average stay of your guests is 7 days or less, and you materially participate in the rental activity. When those conditions are met, the activity may not be treated as a rental activity at all under the tax code, and instead is treated more like an operational business. And what does that mean in real terms? Well, it means that the losses from the short-term rental, primarily driven by depreciation, can be non-passive, and non-passive losses can offset W-2 income, S-corp profit, and 1099 income. This is how you'll hear stories of people saying things like, my short-term rental wiped out my entire tax bill. But that only happens when the rules are followed correctly. Where most people mess this up is material participation. Material participation is where the short-term rental loophole either works beautifully or it fails spectacularly. The law gives us several material participation tests, but practically speaking, 3 matter the most. There's the 500-hour test. You spend more than 500 hours on an activity during the year. There's the substantially all participation. You can do substantially all of the work associated with that rental. And then lastly, there's a 100-hour plus rule. You spend more than 100 hours and no one else spends more time than you. If you do one of these 3, you materially participated. Now let's talk about what counts. Activities that generally count include guest communication, pricing and calendar management, coordinating cleaners and maintenance, furnishing, designing, setting up the property, driving to and from the property, managing the listing and platforms, handling repairs, upgrades, and turnovers. What usually does not count? Well, it's purely investor level activity, passive review of financial statements, time your property manager spends. And that leads to one of the biggest questions that I get. Can I use a property manager and still qualify for the short-term rental loophole? The short answer is it depends, but sometimes yes, but you have to raise the bar. If you have a property manager doing almost everything, you're trying to claim material participation, based on a few emails, phone calls, then you're asking for trouble. To qualify while using a manager, you generally need to show significant involvement in the operations, decision-making authority, have substantial documented time beyond high-level oversight, and this is where time tracking becomes critical. If you're using the STR loophole, you should be keeping contemporaneous logs, the date, time spent, and the description of the activity. This isn't about being paranoid, it's about being prepared for an audit. If you cannot explain clearly how you materially participated, then you probably didn't. Now let's address reps, or real estate professional status. Reps requires two things. First, you must spend more than 750 hours during the year in real property, trade, or businesses, and more than half of your working time must be in real estate. Then you must materially participate in your rental activities. For full-time real estate professionals, reps can be extremely powerful, but for high-income W-2 earners with demanding jobs, reps is often unrealistic. And this is why the short-term rental loophole become so popular. The STR loophole allows many high-income earners to achieve similar tax results without having to spend the 750 hours and more than half test. This is not about which strategy is better, it's about which one fits your actual life. Once you properly qualify a property, depreciation becomes your biggest tax weapon. Depreciation allows you to deduct the theoretical wear and tear of a property over time. A cost segregation accelerates that by breaking down the property into its components with shorter useful lives. Think flooring, fixtures, appliances, electrical, plumbing, and certain structural components. Those components may be depreciated faster, and in many cases, bonus depreciation allows a large portion to be deducted upfront. And this is how a property that actually generates cash can still produce a paper loss for tax purposes. And that paper loss can offset real income. The next one up is a partial asset disposition, or PAD, and it's one of the most overlooked tools in real estate tax planning. Here's the concept. If you replace a major component of a property, like a roof, HVAC, or windows, the tax code allows you to write off the remaining basis of that old component that was removed. And most people miss this entirely. Instead of just appreciating new improvement, the PAD allows you to deduct the old component you disposed of and begin depreciating that new one. When you combine PAD with the STR or rep strategy, it can create additional losses that most investors never capture. And this is especially powerful in renovation years. Now let's talk about strategy that applies to business owners, even if you do not own residential rentals. The self-rental strategy works like this. You or an entity you control can own the real estate. Your operating business rents a property from that entity. Why does that matter? Because in a properly structured self-rental situation, losses on that rental side can offset income from that operating business. Instead of you paying rent to a third party, you're building equity, you're controlling the property, and potentially improving your overall tax income. And this is one of the quietest wealth building strategies used by business owners who think long term. Now, the biggest mistake I see is someone starting with the tax result. And I need to say something very clearly. Real estate should always be a good economic decision first, and then a good tax decision second. If someone is telling you to buy a bad deal because of the tax write-off is great, then that's backwards. The correct approach is buy a solid property, structure it correctly, and track your time properly. Then apply the tax strategies that fit. When done this way, real estate becomes one of the most powerful tools for building wealth and controlling your taxes, not just a risky gamble. If you own real estate or you're planning to, and you want to use it intelligently instead of guessing, here's what you should do next. Go to bristertaxall.com and download the bonus depreciation guide, or check the description below. And if you want help implementing this in your specific situation, schedule a strategy session with my team. We'll look at your income sources, your time involvement, your current and future properties, determining whether STR, reps, or a self-rental, or a combination of all of those makes sense for you. And in the next episode, we're going to be shifting gears into wealth buckets, solo 401ks, Roths, conversions, HSAs, and borrowing against investments without triggering tax. Thanks for watching. If you found this helpful, go ahead and give it a thumbs up, drop a comment below, and if you have any questions or thoughts, I always try to respond. And if you haven't already, hit that subscribe button, ring that bell so you don't miss out on the next video. And if you want to go deeper or grab the resources that I mentioned, check the description below. I've got all the links, tools, and next steps for you there. And if you're ready to talk about your specific situation, you can also schedule a free discovery call using the link in the description. Just pick a time that works for you best. And if you know someone who could benefit from this, feel free to share it with them. It really helps spread the word. Thanks again, and I'll see you in the next one.